Dollar yen daily forecast May 2nd, FXEmpire.com. Dollar yen pair had a volatile day on Tuesday as the 80 level continues to be a magnet for action. The level is a massively supportive area as it is the scene of a massive breakout back in February. The pair has been falling since the middle of March though, and as a result we've been hearing a lot of mixed calls in the marketplace. The Bank of Japan has embarked on large amounts of easing in the form of purchasing Japanese government bonds. The additional 10 trillion yen announced last week actually did very little to stem the rise of the yen, as the market is still also contemplating the words of the Federal Reserve Chairman Ben Bernanke from last Wednesday's news conference, where he suggested that if needed, the Federal Reserve could embark on further easing to alleviate problems in the economy. In this scenario, we have a race to the bottom. It comes down to who can destroy the value of their currency the quickest, and this chart is a perfect representation of that. However, Mr. Bernanke didn't exactly suggest a set of parameters that would warrant further easing, so there's a real possibility that the market may be disappointed. Also, it should be noted that the economic numbers out of America are much stronger than Japan at the moment, so the efforts of a strong yen are starting to show up in Tokyo. The pair has several things going on at once when it comes to the charts now. The 200-day moving exponential average is just below current prices, and this should bring in trend traders and provide some type of support. As a matter of fact, the 200-day EMA is well known as one of the more common indicators used by long-term trend traders and black box systems as well. The pair seems that the level is approaching the 80 handle, and the 80 handle is the site of the 50% Fibonacci retracement level as well. This should become support if the breakout can continue to be proven correct. After all, this is one of the tenets of technical analysis. What was once resistance will become support. It's difficult to think that the breakout back in February wasn't the real thing, as we had daily moving average crossovers on the 50, 100, and 200, as well as a major weekly downtrend line break. It just simply shot up to about 400 pips above this level, and it's hard to believe that that wasn't the real thing. So with so many things lining up at the same time, the risk to reward ratio suddenly becomes a lot more interesting than the typical trade. With this in mind, we would be willing to buy on a break of the Monday highs, as it would show a complete bounce off of this level and could get us very bullish very quickly. The non-farm payroll number on Friday could be seen as an indicator as to whether or not the Federal Reserve will ease anymore, and if there's a strong jobs number come out on Friday, it will have the market thinking that easing is not coming, and this should send this pair straight up. As a result, we do like this area for bullish action, and quite frankly think that we could see it in the next couple days. A break lower would have us avoiding this pair, as the Bank of Japan will more than likely get involved sooner or later.